It is the 20th of March 2023. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500 and gold and also Bitcoin. The subject or theme of today's video has to do with the way in which markets are affected by news events and how those news events can distort cycles in terms of the ways in which those cycles influence the markets that we are looking at. It is something that has been very prevalent in recent market action. So let's start by taking a look at the S&P 500, and this is of course the analysis we've been tracking in these videos for many months. I'm not going to repeat everything and go all the way back to the longer term picture, and if you haven't seen recent market update videos, I would encourage you to go back and take a look at those videos so that you understand the context of each of these analyses. So the important thing about this analysis, as you will know, is that the trough in the middle of October was of at least 20-week magnitude. It is also very possible that that was in fact a trough of 18-month magnitude. Either way, we have been expecting another 20-week cycle trough to form in this market. And as you will remember, in last week's market update video, we discussed the possibility that that 20-week cycle trough had in fact formed over there. But then, of course, there was the Silicon Valley Bank news event, which caused some distortion in the market and forced that market down to form a lower trough. Is it possible that this trough that formed last week on Monday is in fact the 20-week cycle trough? Yes, it is certainly possible. When we are considering the placement of a cycle trough, one of the first things that we consider is the number of bars that have elapsed since the previous trough of that cycle. And so measuring back to the 13th of October, which is when the previous 20-week cycle trough formed, I think 13th is the correct date, you can see that 151 days elapsed up until last week Monday. The average length of a 20-week cycle is 136 days, and so this trough would have formed about 15 days late if indeed the 20-week cycle trough did form last Monday. The other thing that we consider is the recent wavelength at which this particular cycle has been beating, which we take a look at the bottom right hand side of the chart, and you can see over here that the recent wavelength of that 20-week cycle has been 18.5 weeks. That recent average wavelength is in fact presented visually on the chart by means of this circle over here. That circle is positioned, of course, at exactly the point at which the recent average wavelength would complete the next cycle, and so visually we can see from the nest of lows where those cycle troughs are expected. And so it seems likely that this 20-week cycle trough has indeed formed in this market. But how will we know for sure? Well, we will look to our various cycle tools for confirmation that the trough has formed. And the first level to watch is, of course, the 20-day VTL. When price crosses above the 20-day VTL, it will confirm that a trough of at least 40-day magnitude has formed in this market. That is not 20-week magnitude, but because of the fact that we are confident in the placement of the 80-day cycle trough in the third week of December, confirmation that another 40-day cycle trough has formed, given that we must have experienced at least one 40-day cycle since December, and confirmation of the next one would then be the second 40-day cycle to have formed since December. That would then confirm that the 80-day cycle trough has also formed by the principle of synchronicity, and of course that would also be the 20-week cycle trough, also by the principle of synchronicity. The other tool that we will look at is my favorite cycle tool, the future line of demarcation, or FLD. When price crosses above the 20-day FLD, it will confirm that a trough of 20-day magnitude has formed, using the same reasoning I presented a moment ago with regard to the 40-day cycle trough. If a 20-day cycle trough is confirmed as having formed in the market, that will make this very likely as a trough of the 20-week cycle. Now, an interesting thing is happening at the 20-day FLD at the moment, and let's zoom in just a little closer to see in greater detail what is happening. You can see that price has crossed above the 20-day FLD, it would seem, so far in overnight trading on Sunday night. I'm recording this video on Monday morning in Europe, and so the US markets have not yet even opened, but already in overnight trading we can see that price has crept up above the 20-day FLD, crossing it over the weekend. It's extraordinary how often that happens. You will notice that these charts include gaps over the weekend. That's a really important aspect of approaching markets using a Hurst cycles analysis. The reason for that is because Hurst discovered that the cycles which influence financial markets do so in real time, 24 hours a day, 7 days a week, 52 weeks a year. And so it is important that the charts that you are looking at have gaps over the weekend or over non-trading periods. Now, it is possible to work with software that does not have gaps over the weekend if you do a bit of clever coding in terms of displacing this FLD correctly. But we won't spend time discussing that now. The important thing is that it looks as if though this 20-day FLD is going to be crossed. You must bear in mind that the actual price that needs to cross the 20-day FLD is the median price. There is the median price. Of course, we only know the median price once the market has closed for the day, and so it is too early to say, given that the markets haven't yet even really opened in the US, whether median price has crossed above this 20-day FLD. I will be watching with great interest today to see whether price manages to get above the 20-day FLD, because that would provide us with some compelling evidence that the 20-week cycle trough has formed. In the comments to last week's video, there was an interesting suggestion that the 20-week cycle trough had indeed formed over here. And let's just zoom out so that we can see that in a slightly wider context. There we go. So the suggestion was, and let me hide that FLD, that the 20-week cycle trough might indeed have formed over here in the first few days of March. The reason for thinking that, of course, is the fact that if we measure the number of days up to that potential trough, you can see there were 140. Average wavelength of a 20-week cycle is 136 days, and so it was certainly on time. So was it possible that the 20-week cycle trough formed then? It certainly was possible, but in my opinion it is very unlikely. If the 20-week cycle trough did indeed form in price at that time, then price only bounced up for a few days before collapsing down again, which is a very bearish indication, because if this is going to turn into a straddled 20-week cycle trough, which is what the implication would be, then we have turned extremely bearish since that time, indicating that we are looking at a very bearish shape unfolding into the next 20-week cycle trough, which is only expected in about July or August of this year. So what has actually happened here? There's an interesting discussion to be had around news events and how they influence financial markets. It's a discussion that could go on for several hours, so I'm not going to say very much about it in today's video, except to point out that I am always very careful to speak about the fact that the cycles that we analyze in the markets influence those financial markets. A Hurst cycles analysis is more of an art than a science. In fact, Hurst himself said that. And it is one of the things that makes a Hurst cycles approach so fascinating. It is not a pure science, and it is quite possible that the 20-week cycle, at least the influences that we call cycles, were motivating for the markets to form a trough at this point. Price then started bouncing out of that trough, and it rose up and then came down again in what could have been the first 5-day cycle trough. But on the 8th of March, the news of the Silicon Valley Bank failure struck the markets, and so what happened was that, of course, the markets responded, and they responded by moving down to a new low. The markets started settling the next Monday, but in fact the recovery since then, as you can see, has been very erratic, and this kind of overlapping green and then red bar price action, where price moves up strongly for a day and then moves down for the next day and then up and then down again, is a clear indication that the markets are floundering. The cycles are continuing to influence these markets, but that influence does not happen in an absolutely scientific or mathematical way. And so we are expecting a trough to form. Once the news events work through the various stages of creating a shock in the market and then gradually being resolved. And once we know exactly what is going to happen as a result of that, the markets will begin to emerge out of this 20-week cycle trough. When you have a news event that affects one market particularly strongly, it is very useful to look at other markets. We're going to take a very quick look at the NASDAQ. I didn't mention the NASDAQ in the title to this video because we are really going to take a very quick look at it. The point about what is happening in the NASDAQ is very interesting. I presented the NASDAQ in, I think it was last week's market update, or perhaps the market update before that. But the interesting thing is that we have a slightly different position for the 80-day cycle trough, of course, which occurred a week later in the NASDAQ than it did in the S&P 500. As a result, as I mentioned in the previous market update video about the NASDAQ, we have a more balanced picture in terms of the wavelength of the 80-day cycle. And as a result of that more balanced picture, we had a greater focus on the potential formation of the 20-week cycle trough. Here you can see the nest of lows for that 20-week cycle trough, unlike the S&P 500 in which that nest of lows is leaning over, which is an indication that the cycles are diverging from their recent average wavelengths. We have a much neater stack in the NASDAQ. And I am displaying the 40-day cycle FLD, which was cleanly crossed to the upside last week, as you can see by the NASDAQ, confirming that a 40-day cycle trough has formed in the NASDAQ. Now you know by now that the principle of synchronicity tells us that if we are confident in the placement of this 80-day cycle trough, and we get confirmation that a 40-day cycle trough is formed in the market 82 days, as you can see from that bar count, since that 80-day cycle trough, then that must, by the principle of synchronicity, also be the 80-day cycle trough and also the 20-week cycle trough by the principle of synchronicity. Whether it is the 40-week cycle trough is a slightly different discussion. Now let's take a look at gold, and we've been tracking this analysis in gold recently. In the previous market update about gold, the 40-week cycle peak was positioned over here. You can see that the recent price action has converted that 40-week cycle peak from being a stack of triangles marking the position of the peak to a nest of highs, indicating that the 40-week cycle peak was expected there. The reason for that is because price has so recently broken that peak. Why has price broken that peak? Gold is an obvious place that people will run to when they start fearing that their banks are collapsing around them. And of course, the Silicon Valley Bank news was exactly that. There is the danger that the bank system is collapsing, and when there is that kind of danger, people will tend to believe that gold is a safer place for them to put their money. And so we have had a very strong push upwards in gold. The interesting thing about the situation in gold is that we were expecting price to move up in gold. If you take a look at the market update videos, I was speaking about the fact that we were expecting gold to come up into this 40-day cycle peak. And so the way in which this news event has affected gold in terms of the context of the cycle analysis is not necessarily to delay a trough or a peak, although we should discuss whether it has in fact delayed this 40-week cycle peak. But it has simply caused a stronger push up in that direction than might have been expected. So, is this 40-week cycle peak now forming, or did the 40-week cycle peak form over here in January, and all that we are experiencing now is the first 40-day cycle peak, which is what we were expecting to happen anyway? That makes for a very interesting discussion. I'm going to present my thoughts about it here. I believe that it is still likely that the 40-week cycle peak did in fact form over here in January, and that what we are seeing now is still price rising up into a 40-day cycle peak. The reason why this move up is so distorted is because of recent news events. The interesting thing is that the trough analysis, you can see, has sorted itself out very neatly. I speak often about the fact that the peak analysis is more reliable in gold, but that it is useful to keep an eye on the trough analysis. Why do I say it has sorted itself out? You can see these very neat stacks of nests of lows at the foot of the chart, indicating the period of time at which the next troughs are expected. But let's focus on this peak analysis. And we'll zoom out a little bit, because I think when questioning an analysis, it is very important to zoom out and consider where is the most recent time that we are really confident in terms of either the placement of a peak or a trough in that analysis. In terms of this peak analysis, I am very confident about this 18-month cycle peak, which formed in March of last year. In fact, if you go back and take a look at the market update videos which covered gold at that time, you will see that we were in fact expecting an 18-month cycle peak, and one came in pretty much on schedule. If we measure the number of days or bars that elapsed to this potential 40-week cycle peak that formed either over here towards the end of January or perhaps here in the very first few days of February, you can see that there were 330 days or 324 days that elapsed. That is very long for a 40-week cycle peak. In fact, Hurst discussed the fact that cycles seem to stretch longer in gold, but we won't discuss that now. If you take a look at the recent average wavelengths at the top right-hand edge of the chart, you can see that the recent average wavelengths have been slightly long in gold, but not really very long. If that peak is only forming now, it would have taken a very long 377 days to form that 40-week cycle peak. I continue measuring the distances between these cycles, working down one cycle at a time to see where I can find my level of confidence in the analysis. What about this 20-week cycle peak over here in August of last year? That was 156 days, slightly long for a 20-week cycle, but not impossibly long. I am fairly confident in the position of that 20-week cycle peak, because I cannot find another peak within range that would make sense in terms of a better position for the 20-week cycle peak. And so my confidence in this analysis drops down to the 20-week cycle level, or perhaps I should say it rises up to the 20-week cycle level, because I have greater confidence in the analysis all the way to the 20-week cycle level. If we measure the number of bars that elapsed from that 20-week cycle to this potential peak at the end of January or early February, you can see 169, 175 days. Again, a very long 20-week cycle. But if we bring it all the way up to current time, you can see 221 days, which in my opinion is much too long. And so all things considered, I think that it is very likely that the 40-week cycle peak did indeed occur at the end of January. How is it possible then that as price rises up to the first 40-day cycle peak following a big peak of the 40-week cycle, how is it possible that it has risen up to a higher price? The answer to that, in my opinion, lies in the fact that we have identified a very big magnitude cycle trough over here in September, or perhaps in November, as discussed in previous videos. That is a trough of the 54-month cycle. That's a really important, very big trough that has formed in gold. Following a really important, very big trough, such as the 54-month cycle, we would expect to see some very bullish market action. Our first 20-week cycle in terms of the trough analysis was a very bullish cycle, and of course, given that very bullish cycle, we experienced, as expected under bullish underlying trend conditions, a late peak. And that is why, in my opinion, these peaks have been occurring late. What are we expecting for the next 20-week cycle? Again, we are expecting a bullish 20-week cycle. So in terms of the trough analysis, it makes perfect sense that we are witnessing a very bullish move at this point, because of the fact that we have recently experienced a 54-month cycle trough at the end of September or early November last year. That is why I think it is really important to watch both analyses, both the peak analysis and the trough analysis. It also explains why it is possible that a 40-week cycle peak formed over here, and that the first 40-day cycle in terms of the peak analysis has been a very bullish one. Of course, recent news events have distorted this move, and it is possible that when those news events settle down, this increased volatility that we have witnessed in the markets will die down. But the markets have not behaved in any way that contradicts the cycle analysis that we are looking at. And I should remind you again that these cycles influence price movement. This is not an absolute science, but they do provide us with information about the underlying influences behind price movements to help us understand price movements in the past and anticipate price movements in the future. Bitcoin makes for a fascinating study at the moment, and the interesting thing about Bitcoin, for those of you who subscribe to our Macro Outlook newsletter on Hurst Cycles Notes, you will have seen this morning the discussion about the correlation between Bitcoin and gold recently, and Bitcoin and gold's correlation has been increasing tremendously recently, which is an interesting discussion, probably for another time. But of course, Bitcoin has recently increased in value tremendously, and again, a possible reason for that is that cryptocurrency, and Bitcoin in particular, are probably seen as a safe haven away from a bank system that seems to be failing. But now let's take a look at our analysis of Bitcoin, and in my recent Bitcoin update, I mentioned the fact that the 80-day cycle trough formed over here in all likelihood, and that we were expecting a 40-day cycle trough. I also pointed out this floating circle and whiskers for the 20-week cycle and mentioned that that was something to pay attention to. What does it mean when we get that floating circle and whiskers? It suggests the possibility that this 40-day cycle trough is not just of 40-day magnitude, but might be of greater magnitude, in fact of 20-week magnitude. As you can see, price has bounced up very strongly out of that trough, indicating that indeed this trough probably was of 20-week magnitude and not 40-day magnitude. Fortunately, the fact that there was a floating circle and whiskers over there gave us some prior warning, but as price started moving up very strongly, it caused me to take a step back and consider what was happening with this analysis. And this is another interesting situation because of the fact that Bitcoin has been so strongly affected by news events. In fact, the news events that affected Bitcoin occurred last November. So let's zoom out and consider how news events have affected Bitcoin. You can see this very strong move down over here, which was the reaction of Bitcoin to the FTX situation. And then we have a period of time over here where price effectively went nowhere. It was similar to what has been happening over the past week in the S&P 500, with up days and down days pretty much alternating and not very much overall movement. Then suddenly we had another strong move up over here, giving us an interesting situation where the FTX news caused a strong move down, and then later we witnessed a strong move up, providing us with a displaced section of price movement. As you can see in our trough analysis, we have the 54-month cycle trough positioned over here. It is positioned, of course, beneath the lowest price during that period of time. But can we say that is exactly when the 54-month cycle trough occurred? No, because of the distortion in the price action due to the news events. When a news event causes distortion in financial markets, we have to take a bit of a step back to consider what is happening with the cycle analysis. The cycle analysis will not change, but we've got to be careful about positioning our cycle troughs and then ardently counting the days following those cycle troughs when we are not absolutely confident in that trough placement. So again, I will zoom out a little bit in price action and consider where is our level of confidence in this particular analysis. If we scroll back and zoom out, you can see a very clear price trough that formed over here in the middle of June last year. I'm fairly confident about that trough, and I think the fact that it was a 20-week cycle trough is also something that I am confident about. I'm not going to zoom even further out and discuss that in detail, but let's just assume for now we are confident in the placement of that 20-week cycle trough. If we measure the number of bars up until this 54-month cycle trough, you can see there were 156 bars, a fairly long 20-week cycle. But here is the interesting thing. If we measure all the way up to the recent low, which occurred on the 10th of March, following the Silicon Valley Bank news, you can see there were 265 days. Now, the average length of a 40-week cycle is, in fact, 272 days. And so this is a period of time at which we would have been expecting the second 20-week cycle trough following the trough in June of 2022 to form. I hope that makes sense. The average wavelength discovered by Hurst 50 years ago of the 40-week cycle, in other words, two 20-week cycles, is 272 days. At 265 days, this is a very likely time for the second 20-week cycle trough to form following the trough in June of last year. And of course, that is why we have this circle and whiskers of the 20-week cycle over this period of time over here. Why is this nest of lows displaced to the right? The reason for that has to do with the placement of the shorter cycles in this analysis. In particular, of course, the 80-day cycle trough there, and there, and there. If we measure those lengths, you will see we have a 95-day, 80-day cycle. That's really very long for an 80-day cycle, which averages 68 days. Then we have a short cycle at 61 days, and then we have a fairly long cycle at 84 days. So what is going on over here? In my opinion, the placement of these shorter cycle troughs is unreliable because of the fact that we had this period of time over here where price action was indeed unreliable because of news events. So what can we do? What does this mean about our cycle analysis? Is it completely incorrect? No, we are definitely expecting a 54-month cycle trough to occur at around about this time, but news events caused some distortion, so it might not have occurred on exactly this day. It was certainly expected to occur around about this time. So what we can do is we can influence our analysis and reposition the shorter cycles that are causing this distortion. I have done that in this analysis over here. You can see the 20-week cycle trough over here in the middle of June as expected. The only thing I have done to influence this analysis is suggested that the 80-day cycle trough actually occurred over here in the middle of January. This means that this trough over here was the 40-day cycle trough, and of course we had a 20-week cycle trough that occurred over here on the 10th of March. Here is the nest of lows for the 20-week cycle trough. You can see that it is looking much more regular, and this is probably a better analysis. And so what is happening to Bitcoin? The overall message for Bitcoin is still that a 54-month cycle trough formed in November of last year. What we have experienced since then is a bullish, if slightly distorted, cycle for the 20-week cycle, distorted because of the news events, and price is now bouncing up in the beginning of the next 20-week cycle in terms of the trough analysis. But again, we must pay attention to both the peak and the trough analyses in Bitcoin because both of them provide us with useful information. And in particular, you will notice this circle for the 18-month cycle peak. Here is the nest of highs for the 80-day cycle peak, and floating below that nest of highs we have an 18-month circle and a 40-week circle, indicating that the time is ripe for the next 18-month cycle peak to form in Bitcoin. And so what is happening at the moment in Bitcoin is, of course, that price is rising up from a 20-week cycle trough that formed over here earlier in March into an 18-month cycle peak. I do hope that you have found this market update useful and interesting. If you have any questions, please join us on our Discord server, and you are also, of course, very welcome to put them in the comments below this video. I look forward to hearing from you.